Before paper money, gold was king. But how did it become so valuable? Gold has been used as money for thousands of years, and it wasn't just because it looked good. It was valuable, rare, and didn't tarnish. Ancient civilizations quickly realized that gold was the perfect medium for trade. It became the backbone of early economies, with people exchanging goods and services for gold. But carrying large amounts of gold around wasn't very practical, so early banks were created. Think of them as gold warehouses. You deposit your gold for safekeeping and receive an IOU in return. This IOU could then be traded for goods, just like gold. Over time, these IOUs evolved into the paper money we use today, but gold remained the trusted standard of wealth. Gold didn't just shape economies, it shaped the entire concept of money as we know it. And even though we don't carry gold in our pockets anymore, its value has stood the test of time. Imagine being told it was illegal to own gold. Sounds unbelievable, right? But it actually happened. In 1933, during a time of economic crisis, new laws were introduced that restricted private ownership of gold. People had to exchange their gold for paper money. Why? Gold was seen as a limiting factor in managing the economy during the Great Depression. Fast forward to the 1970s, and another major shift took place. Up until then, every dollar in circulation was backed by a specific amount of gold, which helped control the money supply. But in 1971, that system was abandoned. This change allowed central banks to print money without needing gold reserves to back it up, essentially creating money out of thin air whenever it was needed to solve economic problems. This marked a huge turning point. Without the constraint of gold, money could be created more freely, but it also introduced a greater risk of inflation. As more money enters circulation, its value can drop, leading to rising prices. That's why gold is still seen as a safeguard today. It holds its value when other assets and currencies lose theirs. Did you know that inflation is like a sneaky, invisible tax? And guess what? Gold has been fighting it for centuries. Inflation is what we call a stealth tax. It silently chips away at the value of your money year after year. As currencies lose their purchasing power, people have always looked for ways to protect their wealth. And historically, gold has been a go-to solution. Gold acts as a hedge against inflation because, while currencies like the pound or dollar weaken over time, gold tends to hold its value. For example, during periods of high inflation, like in the 1970s, gold prices soared. What was happening? As the value of money dropped, gold became even more desirable, preserving wealth when other assets were losing value. So whether inflation sneaks up or hits hard, gold often remains a reliable way to protect your purchasing power. When the value of your cash shrinks, gold steps in to hold its ground. Thinking of investing in gold jewellery? Here's why that might not be the best way to grow your wealth. While gold jewellery is beautiful and holds sentimental value, it's not the most effective way to invest in gold. Here's why. When you buy gold jewellery, you're not just paying for the gold, you're also paying for the craftsmanship, design and fashion markups. These extra costs mean that even if the price of gold rises, the value of your jewellery may not increase in the same way. Plus, when you sell, you might not get back what you expect, since buyers often consider only the metal's value, not the work that went into it. So, what's the better option? Gold coins and gold bullion. When you buy gold in these forms, you're paying for the gold itself, not the craftsmanship. Reputable bullion dealers sell gold at small margins and high volume, meaning you're getting more value for your money. This is how you can truly capitalise on gold's potential as an investment. Investing in gold coins or bullion allows you to benefit directly from the rise in gold prices. And remember, this is a long-term strategy. It's not about getting rich overnight. It's about steadily building wealth over time. With the right approach, gold can be a reliable part of your financial plan. Is gold the secret to getting rich quick? Not exactly, but here's why it's still a smart move. Gold is often misunderstood as a quick way to make a fortune, but the truth is, it's a long-term investment. It's not about watching the price spike overnight. It's about steady growth and security over time. When you invest in gold, you're looking for stability, not a lottery win. The key is consistency. By investing what you can afford each month, whether it's a little or a lot, you're building a foundation for your financial future. Gold has a history of holding its value and often appreciating, especially during times of economic uncertainty. But remember, this is a marathon, not a sprint. Patience is crucial. One major perk of investing in gold coins is that in many countries, they're exempt from capital gains tax when you sell them. This means more of your profit stays in your pocket. So, While gold may not be a get-rich-quick scheme, it is a solid strategy for preserving and building wealth over the long haul. Enjoyed this video? Make sure to subscribe to our channel for more jewellery, education and insights. Plus, get an exclusive look at how we create stunning pieces right here in our workshop. Hit that subscribe button and join us on this sparkling journey.